Everyone wanted to work for Gordon Capital. They were the most aggressive firm. They were just awesome. And so I send the letter. A week later, I phone up and say, I phone the trading desk and I say, is Howie there? And Howie was the head trader. I say, hi, Howie, it's Kevin Muir. I sent you a letter. But he goes, what are you doing? And he starts just screaming at me, Boris, yelling at me with F-bombs everywhere. This was demoralizing. I still remember my first trade. I think I bought the US dollar. It was the US dollar index. It proceeded to go locked limit down against me.
I was going to say.
My first trade was literally like a lock limit down the other way.
There's nothing worse than having conviction and seeing the trade just, run away from you.
That's the most painful thing ever, is to be right and not have the right size on.
It is. I actually think that is worse.
I completely agree.
Than being wrong in a position. Hi, everybody. This is Boris Schlossberg. Welcome to the Trading Battle. Today, we have truly a very special guest. I say this every show, but today I am especially happy to have this gentleman join us. A good friend of the show, Kevin Muir, who I'm sure you're very, very familiar, Mr. Macro Tourist himself. Great name, by the way, for his podcast and for Macro Huddle and for his letter. And he, of course, is very, very well known as both a trader and a macro analyst. And he's got a great podcast. If you don't listen to it, it's my number one go-to on the weekend. I highly recommend it. He's got some very smart people on it. But today we're going to talk really not so much about markets. We'll do a little bit of that as well, but generally about his life as a trader, because I think that's what a lot of people have never really heard about and probably are very much interested to know, because, you kind of just stumbled into this business like almost everybody else did, right? One way or the other. And I'm sure people would love to know what was the opening, drive to have you come into the business. I know your dad was in the business,
right?
And you talk a lot about that.
Yeah.
But was that, was he the primary catalyst for it, or you just sort of after exhausting every other option, okay, maybe I'll go into finance?
No, actually, well, first of all, Boris, great to be with you. It's nice to be on the other end of the interview microphone and actually be the interviewee instead of the interviewer.
Yeah,
that's right. So you could put me on the hot seat. In terms of me growing up, my mom wanted me to be a doctor or a lawyer, and my dad grew up in. He was the research director for kind of it was a smaller Canadian, like a second tier brokerage firm, and he was the research director. And so I always grew up talking about stocks at the dinner table. It was always, and it was like Moose Pasture Mines. It was all these crappy gold stocks in Canada, and you have to remember this is in the 1980s. But so I was always kind of fascinated by that. And my dad always tells the story about how much I loved games. And I would agree with him that I still love playing games. And when I think about going back to school, I can't imagine going back to university. But if I had to, I know which course I would go and what I would specialize in, and it's game theory. Love it. It just fascinates me, the whole strategy, how it all works and stuff like that. So I was always a big fan of games. I was always listening to my dad talk about stocks. And then when I was younger, I stumbled upon Market Wizards, which, was the kind of book that turned a lot of people.
Speaking of Market Wizards, one of the absolute most common themes in that book is that all the traders view the market as a puzzle. Yes. They all talk about it as a puzzle, which is very apropos to your kind of interest in it. It's
right.
Cracking the code. It's that drive that many people are attracted to.
And by the way, remind me of that question, because I do have an interesting insight that I realize where I'm slightly different than some other folks about that in terms of what drives me. But let's just kind of go with the story here. So I stumbled upon Market Wizards. I instantly knew that this is what I wanted to do. I had no interest in doing stocks, individual stocks. I didn't like, accounting. I didn't like figuring out PE ratios. I wanted to trade macro stuff. So I remember I opened an account. My dad took me and co-signed a futures account when I was, 16 or whatever. And I'd saved up some money, put it in there. I still remember my first trade. I think I bought the US dollar. It was the US dollar index. It proceeded to go locked limit down against me.
I was going to say.
My first trade was literally like a lock limit down the other way.
I was going to say, how were you thinking to lose that account? Was it a week or a month?
And it wasn't very long at all. And I remember my dad telling the broker, he says, just don't let him lose more than I'm putting in here. We're putting in here. And that was it.
Just make sure the margin call goes out.
That's right. So it was just kind of, I was hooked, even though I was a losing trade. And in hindsight, it was probably the greatest thing for me that it was a losing trade and not a winning trade. And so from there, I proceeded to do everything I could to immerse myself and try to find out how to make it into the macro world. And eventually I was going to university and I got a job doing it was a discount stockbroker. And this is in the 90s. And I remember they hired me, and it was post the 1987 crash. Actually, it was late 80s, post the 1980 crash, early 90s. And they were scared about hiring people because they were all picturing the market was going to turn over again. So they hired me on a contract basis. And so they used to say to me, can you come in after school, after university, and answer like the phones and give quotes and stuff like that? And so I did. And next thing I know, they would be like, oh, markets are busy. Do you mind like working during the day? And I'd be like, oh, sure, class, doesn't matter. Let's, this is great. And I was making good money. And it was one of those things where they paid you on a contract basis where there was no withholding. I was doing just terrific. And and I was working like 12-hour days. I would get up at 8 and work till 8. Eventually they were like, this is ridiculous. We're paying you so much money. We're going to have to put you on the payroll. So they put me on the payroll. And then next thing I know, they made me literally the head of this little trading desk. And it wasn't like, it was just because nobody else knew how to do it. It was also new and early. And so I was 21 years old or 20 years old. And I was the head of this trading desk, and I was like a bank M5 manager or something. I was doing really well. And I looked around and I said, like, this isn't what I want. Like, I want to be a macro trader. This is like, I'm working for a bank. What's this about? Like, it was just, it was like this little moment. And so I started asking around, and I eventually found somebody, a friend who, he traded a lot of futures in Chicago, and he got me a job at his broker. So I picked up and I went to Chicago into the pits. So I was in the DMARC pit.
I didn't know you were the pit.
Yeah. Well, listen, I didn't last very long because I hated it. And it was just,
which fit were you?
I was in the DMARC pit, and, it just wasn't for me. I literally was there like a summer, and I was like, this isn't for me. And I realized that
I'm just curious, like in those days, I mean, FX now spot is obviously all 24 hours a day. It's all electronics continuous. But in those days, like they had gap openings, right? Because they were, they like currency futures were traded like stocks do today, in a sense that they lose with these gaps because Europe would move the mark a lot.
For sure. And it was crazy. And it was way more physical than I ever imagined. And I think that people from Chicago would probably, attest to that. Yeah. And by the way, like, Chicago pit traders are my absolute favorite. Like you mentioned my podcast, I love interviewing them. I just love them. Like they are just their no BS attitude, their understanding about taking a risk. They just, to me, they are the greatest bunch of people that if I had to go and trade in a room, I would take a Chicago pit trader any day of the week. Like, I don't know why. They don't get offended by anything. They're not trying to prove anything. They're just that they understand that for every trade, there's someone on the other side. There's no BS about them. I just love them. But having said that, it wasn't for me. And so I came home, and I was lucky enough at the time, I was into computers, and I was a little bit of a nerd, and I was into markets, and I started... And I'll tell this story because it's kind of funny. So my dad tells me, he says, okay, this is what you're going to do. You're going to make a cover letter. You're going to put your resume, and you're going to make this cover letter. You're going to pick 5 or 6 desks that you want to work for, and you're going to mail them the letter, and then you're going to follow up with a phone call. So I'm 21 years old or whatever. So I do this thing. I mailed them off, and I still remember the first one. I wanted to work for this firm that was called Gordon Capital, and they were like the originator of the bought deal in Canada. They were just the bee's knees. Everyone wanted to work for Gordon Capital. They were the most aggressive firm. They were just awesome. And so I phone up, I send the letter. A week later, I phone up and say, like, I phone the trading desk and I say, is Howie there? And Howie was the head trader. And all of a sudden they go, Howie. And so he gets on the phone and I say, hi, Howie, it's Kevin Muir. I sent you a letter. But he goes, what are you doing? And he starts just like screaming at me, Boris, like yelling at me with just F bombs everywhere. Yeah. Just like going, why am I wasting his time? Don't ever call him on the trading desk. Yeah. And I was just friggin' like heartbroken. Like this was demoralizing. So I hang up the phone sheepishly and I sit around, and my dad comes home that night and he says, how did it go? And I tell him the story and he laughs. He goes, I guess that one didn't go very well. How did your next one go? And I said, what do you mean? How did my next one go? And he says, well, you called the next guy. And I said, no, I didn't. I'm like, no, these guys don't want to hear from me. And he says, get on the phone and call the next guy. And it was such important advice. And it's one of those moments in life that changed my life forever. And I'm forever hugely, thankful to my dad that pushed me to do that. I was lucky. I phoned the next firm that I wanted to work for. It's this firm called First Marathon. I was lucky enough to get this guy called Mike Weckerly, who's a legend in the business. He's one of the greatest block traders in Canada that's ever lived. He didn't hire me, but he was very kind. He took time and he chatted with me. And he was just super nice guy. Gave me the courage to call the next one, which was RBC. And RBC, which called back then it was RBC Dominion Securities. And they were looking for somebody that was going to do their index business. And this was when Wells Fargo was the big indexer, and that was their client, and they needed a young person to do this. And my boss says to me, he said, there was guys that were better at trading. There was guys that were better at computers, but you were the right mix of both. And so I was lucky enough to be hired when I was 21 years old. I hadn't even finished university, onto the institutional equity desk at RBC Dominion Securities. And it was the ideal, perfect place for me. It was the Goldman Sachs of Canada. They didn't, if you were entrepreneurial, they let you run with it. And I just excelled there. And it was the greatest. I was lucky to be in the right seat at the right time at an exciting moment in history when the world was going more computerized trading. And it was just, it all lined up, and I had a great kind of 6-7 years there.
Now, when you say you were good at computers, like, were you programming? Did they hire you to?
It was, Boris, it was barely like, I knew how to use Excel and bring it into a spreadsheet and live quotes and stuff. It was nothing. I did do programming, and I eventually did like program things, but it wasn't like what you'd expect today.
Index trading was basically essentially Excel trading. It was just balancing like the whole,
So we were using this Unix box that was called Quantex. And it was actually, you did need to know, it wasn't really Excel, and you did need to have some computer background. You needed to know Unix and things like that. So I got better at it. But it was just kind of a familiarity with computers, because don't forget, most traders didn't, like, they were old school. Like they did.
And this is what year was this when you sat?
Like 93?
Yeah, 93 computers were like, weren't even common to people.
So we used to price baskets. So my original job was to handle the clients, the Wells Fargo client, and we would do their big, huge programs. And then I also RBC was the best at what's called liability trading on baskets. So we would go and offer and bid for baskets. So what would happen was the client would fax us a portfolio. And oftentimes what it was, like, if a client won business, let's say a pension fund was with money manager A, and then they wanted to switch to money manager B, they would go and they would actually give the portfolio to money manager B, but money manager B would have all of money manager A's picks. So they would just want to get it over with and like switch it to their portfolio quickly. So we would price out these big, huge baskets, and those were, you had to use live quotes, and then you had to print the whole thing on the exchange, and then you had to make sure all the different traders would take their pieces and things like that. So it was,
and the deal was like, you're good, I'll give you this firm quote for the whole basket, and then you took the liability of making sure that the prices didn't move against you too much. And obviously,
and that was the guy that was pricing that was our head trader. So I was lucky enough to sit beside him and sit around there, and I was exposed to a lot of things that really helped me learn how to trade.
It's fascinating. Within that business, what were the key variables that that would move prices that he would constantly try to ascertain in order to make sure that he was on the right side? Was it volume? Was it, was there news pops that sometimes hit you guys? Like, what were the things that from his experience that he would always be, watching out for when you were sitting on those big index bonds?
So those baskets, inevitably there would be a whole bunch of stocks that you wanted, that you knew the clients wanted to trade, that you would get paid commission on. So you'd have those, and then you would instantly, people would they would be happy to like sell on the offer. And don't forget, those are the days of eights, Boris. So like the bid offer spread is much wider. So they would be happy to sell on the offer. And the real problem was there was always one or two duds. And it was really the game was all figuring out like the duds and figuring out what you're going to get stuck with.
What you can wait. And those were, and obviously they were also large size probably because they were probably low volume. Like they probably traded 10,000 a day, and the guy had like maybe 50,000 on his books, and you were trying to.
It was. I remember there was one money manager that kept losing money. And that we would keep winning these baskets, and we would do all the business, but there was one stock we couldn't get rid of. And I can't remember what stock it was, but I remember at a certain point we had to stop bidding on baskets. We had to tell them to take out that stock because we were pumping up against the 10% threshold.
Wow!
And that was the thing. Like RBC, had a big balance sheet. We were able to sit through things more so than others.
Eventually, just blow it out. Yeah. That's wild. But that was the art, right? That was the art, really.
Yeah. And I'll tell you, like, this is a podcast about trading and learning about trading. I'll give you some kind of a couple of stories on that desk that were kind of momentous for me and what I was so privileged to sit and watch my boss do. Mm-hmm. And I remember this was just his regular market making and making trade. There was a new IPO coming out, and I think it was a hydro company or something. And again, these are the days of eights, and I think that there was a derivative that was based upon a receipt. So there was kind of a complicated arbitrage you could do. But the long and short of it was a very liquid day on a new stock, and it was like, let's say the stock was 8.5 to 8 5/8, and it was coming out, and it was issued at 8 1/4, something like that. So the first day comes out, and I remember the trader that was in charge of that kept going and saying over the squawk, he kept saying, I'm 8.5 bid $250,000, and I'll offer $500,000 at 8 5/8, meaning he was just showing the same that was already on the board. And I remember my big boss, the guy that I was lucky enough to learn a lot from, he took it over, and he never put it in his own orders, Boris. He would just kind of whisper them to the trader beside him. And I remember watching, and he would say, like, okay, get me on the offering at 5/8 with $1 million. So the guy gets him on the offer with 5/8 $1 million. And he says, sell $500,000 at a half, meaning he hit the bid with $500,000. So he gets on the offering with $1 million at 5/8. He hits the bid with $500,000 at a half. Then as he watches it, and it's kind of like a little bit shaky. And so he says, this time, and he hasn't said anything to the sales traders out there. He still hasn't tried to make trade. He's sitting there, he's watching it, he's thinking about what he's going to do. And then he waits for his chance. And then all of a sudden he tells the trader beside him, he says, sell $1 million at a half. So he hits the bid with $1 million. And now all of a sudden the market is 3/8 to a half. Okay. And at that point he sits there and he says, I'll pay the offer for 1 million shares. And he screams it out, and everyone's like, all of a sudden it's changing. And it was just this wake up call. And I know that doesn't seem that it doesn't seem that groundbreaking, but in terms of making trade, it just showed you how you had to be kind of one step ahead. Just going out and saying, I'll buy on the bid and I'll sell on the offer, that wasn't going to get you any business. That wasn't going to get you in the flow. So he made it so that he was short at a half. And so he could pay the offering for a half. All of a sudden he finds out, so now the guy that wants to sell it, the client that wants to sell it, Ontario Teachers, Canadian Pension Plan or London Life, whoever it is, they say, I'll sell, $1 million at a half. They take the trade. We do the trade. Now all of a sudden, they're a seller, where they are, and we proceed to trade all day. Right. And it was just this like wake up call in terms of how to make trade. That was just, the kind of smarts that he had versus everyone else in terms of thinking that next step instead of just saying.
It sounds like he was almost just sort of playing, poker one step ahead, just sort of making the guy show his cards,
right?
Forcing the guy to show the cards, and then actually making the play after that.
Okay, and I got one more story that I remember because it was so impactful on my life. One day, so I'm sitting there, and I was hired by a younger guy who worked for this big trader. So we kind of both worked for the big trader, but I technically reported to this younger guy, and I did the baskets and things like that. So I wouldn't do the individual stock trading, my immediate boss did. All of a sudden, the big trader gets a call overhead, which was weird because usually you have direct lines to everyone. So he gets the call overhead. He goes, whispers back and forth. And then he comes out and he says to the young trader that's my boss, he says, start buying Methanex. And the guy says, and my young guy says, well, how much? He goes, let's put it this way. He said, I'll tell you when you get close. So we started buying this Methanex. It was like a energy stock. And we bought it for, I don't know, a month. And along the way, it was just like we just kept buying it. And well, let's say we started at 12. I think we ran it to 18 or 19, like trying to buy all this stock.
Right.
Remember along the way, I was like, who's buying this? Like I would ask, and he'd say, the young guy would say, Tiger. Like I'm supposed to know who Tiger is. Like I'm like, so I go home that night and I get on my AOL dial up and try to figure out who Tiger is. And obviously I figure out it's Julian Robertson. And so I watched them take this stock from like 12 to 19 or whatever it was. Then they take it to 20. And then all of a sudden there's a call overhead from my big boss. And I'm thinking, okay, this is it. This is the end of the order, right? Like this is finally the time where it's going to be over. And the call goes on forever. There's like negotiations back and forth. I don't understand what's going on. And eventually what happens is after kind of a few hours of this, the boss hangs up the phone and goes, listen up, everyone, tells the desk. He goes, so imagine the stock's at $20 at this point. He says, we're going up on 12 million Methanex at 18.5, which is down $1.50. Okay. From where it is. Yeah. We're going up on 12 million Methanex, 18.5, we come out a better seller. And what I found out later was that this was Soros coming, selling it, and had understood the game well enough that he was prepared to sell it down $1 to fill the Tiger, right, and then even sell more. And from then I watched the stock, and Soros proceeded to go back down to 12. And in my mind, Soros was always better than Tiger because of this one single trade. So he basically, he had the confidence to undersell the stock because he saw the vision. Right. He understood that it was only up there on this one guy's buying. Right. And he understood to get he was better off doing the trade down $1.50 and getting it all than sitting around and trying to, stop the stock from going up and then finding the thing sagging back down.
People used to always say this to me too, like the worse the fill, the better the trade. Sort of like, the idea is, if you have conviction, you cannot putz around. I'm trying to keep this family friendly, and try to, finesse the price. If you want to be in the trade, you got to grab it because if you have conviction that's going to go, because there's nothing worse than having conviction and seeing the trade just, run away from you.
That's the most painful thing ever, is to be right and not have the right size on.
It is. I actually think that is worse.
I completely agree.
Than being wrong in a position.
Yeah.
Yeah.
Yeah. I completely agree.
Like, you do all this work and it runs away from you and you're like, that's why I'm always market entry. I'm on market entry, limit exit. There's a lot of guys who, no, I'm always limit entry. I'm like, if you limit entry, you will, you'll never be able to get into it.
Well, and not only that, in this day and age, I feel like the quote is such BS anyways, because it's moving around so much. So they're like with pennies and, or even futures, the bid offer spread is so little. Like
Right. What are you trying to say? The one tick that is the bid offer spread. And at the expense of, if your trade is, 20 ticks forward, that's what you're going to give up if it doesn't.
Yeah.
I agree.
Yeah. No, I'm with you. I completely get it.
But that's so interesting that Soros was very smart in, I never thought, Tiger was never really a great trader. He was sort of a good investor, but
right.
But that's very actually. Wow. So you really understood. You really saw sort of the back door. Now this it sounds like you're doing a lot of American business.
No. Well, so this was Canadian stocks that the Americans were trading. Like, so there was a Canadian
play for American hedge fund managers.
Yeah. So we would have a lot of
just because they would go to you because you were known as the best.
Right.
Was it like that? Did you ever have situations, where I remember when I was on the market maker desk where like it had nothing to do with the price of the stock. It would just be like the two market makers would just, like two rams, both butting their heads. And like, whoever had the bigger balance sheet would try to bully the other one off the thing. And then of course everybody like a little parasite would watch, who's going to make the move. And then as soon as one guy had the advantage, they'll just jump on that direction of the move. Did you ever have any of that happen?
For sure. So eventually I did a year or two of, working for these folks. And then there was an opportunity and I wanted to trade proprietary full time. Like I said, I don't, right now I'm doing these baskets, I'm doing this and this, and I want to trade pro. Interestingly enough, Boris, I actually went and another firm tried to recruit me and he said, well, what do you want? And I said, I don't want to have to deal with clients. I just want to trade pro. And he offered me a job. So I came back that next day and said, I'm going to work for this other firm. And they said, well, what do you want? And I said, well, I've been telling you for a while, I want to just trade pro. And they said, okay, can you give us the day? So I sat there for the day, not allowed to trade, just waiting. And they came back to me and said, okay, listen, this is what we're going to do. We're going to give you the equity derivatives book and this is a new group and you're going to be in charge of the index derivatives. And, Bob's your uncle. Good luck. Wow. And so I stayed and it was the greatest thing ever. And so I very quickly at a young age ended up being in charge of the equity derivative risk.
But that is really not an easy product. I mean, that is, and it's like from frying pan and, into the fire, right? I mean,
but there's a lot of ways to get rid of the risk. So if you're good at computers, you're good at pricing stuff. And one of the things that I was really good at was, getting my costs really down. And I remember I would like at one point, even before I was on the equity derivatives group, the main desk used to go and they had these markets in what's called receipts. And they were kind of the promise to buy a stock forward. And these were equity traders, Boris, and they didn't understand like the cost of funds and the borrow. And they were just pricing this stuff off of like nothing. And I'd be like, what are you guys doing? Like I looked at it and one of the problems was they were earning big credits. They were buying the receipt, shorting the stock, earning a credit. But the trouble was the curve was very, was very normal. And it was steep, meaning that they would buy this 1 year. They would look at the 1 year BA, which is banker's acceptance, which is kind of like our LIBOR rate. And They would go look at it and they would say, look, 1 year BAs are 7%. So I'm going to price this at 7%. And I'd be like, but the overnights are like 5 and you're not locking it in. You're losing money because you're really only earning 5. And then there's all these other things. So they actually put me in charge of making markets, just like this was even before I went to the derivatives. Cause I said to my boss, I said, look, you guys are doing this all wrong. And I explained it to him and he's like, yeah. Okay. And he said, well, make us a market, do better. So they put me in charge of this. So I didn't actually take anything except this tiny little bit of, it was in essence T-bill risk, but they just didn't understand it. The equity guys were not very sophisticated when it came to understanding those things. So they used to make markets like the spread market would be like 3.5 to 3 3/4 on the spread. And I would like within, a month, I was like, oh, I'm 355 at 358. Like it was just like, it was T-bills. Like it was the easiest thing in the world. So when it comes to the derivatives, it was the same. I found the same thing happened. There was a million different ways for me to lay off risk. Like I could trade baskets. I could go trade the what's called the XIU, which was kind of like the spiders, and I could go trade futures. And there was a million different ways. So it was
pretty much directional risk that you were holding. It was always
so at times we took a lot of directional risk, and it was for little brief periods, but that wasn't kind of the meat and potatoes of the business. The meat and potatoes was just to turn over the book and just continually make markets and looking for arbitrage opportunities. And so I literally would just be...
When would you guys take directional risk? When there was massive dislocation in the market and you felt...
sometimes So I think one of the most important things about traders is they should understand their weaknesses. And I'm going to tell you one of my weaknesses, Boris.
Yeah.
I friggin' love being right when everyone else is wrong. So, and the thing about an index futures trader that's doing the ARB is that we are always providing liquidity. So I was always on the other side of all the.
So if there were buyers, you were always a seller. If there were sellers, you're always a buyer.
That's correct. And I sold it and then tried to get it back cheaper and stuff. But there would be nothing more like I know this isn't the right trade, but there's nothing that I enjoy better than like a gap up opening that then fails, and like I've just sat there and just sold it, and then the thing just collapses and finishes at the lows of the day. Like those are like my favorite trading days ever. Yeah. And it's probably it's wrong because the gap up openings, if you actually look at them from a statistical point of view, you should be buying them and going with it, and that's the real problem. But every now and then there's a spectacular failure. Right. And when they happen, they're just awesome.
We always love to chase the lottery ticket. That's our.
Yeah.
The whole thing is that we always say, we're trading against the crowd. We're not chasing, but we're chasing that one failure, which is rarer than actually than all the other moves.
And I probably cost myself more money than I can ever express trying to recreate like a couple of days that I had when we went out into the pit and would provide liquidity. We're short out the yin yang, and then the thing collapsed and we got to buy back. But it was kind of more complicated than that. We would take
because so many people who are watching this are retail traders. I think it's really important for them to understand. Like that is the reason why all prices, but especially sort of stock index prices or just individual stock equity prices, will have this wave function during the day, because the market makers are everybody has demand for the product, right? The market makers will satisfy the demand, but they, as you said, you have to get it back. Like, you scale up, you're selling some at 20, some at 30, some at 40, some at 50, maybe even like a lot more at 70. So you average your average weighted volume, which everybody always loves that, is at this level. You need to right away capture that profit back. You don't want it to run away, because then it becomes a big P&L issue on the book. So what happens is you'll see prices rise and it'll just dip a little bit. That dip very often is market makers taking the inventory back, and then the second wave, then this the second act comes. And that happens all the time as the wave action in prices.
Now, the other problem is that trading has changed. So in our day, Boris, when you and I used to trade way back when, there would be institutions that would come in and actually buy a chunk at a specific time of the day and may have a view. Yeah. Nowadays, they stick it in the VWAP or the TWAP and they just algo it. And so what happens is it just like this is, I find the most frustrating thing about the current market, and I understand it and I'm trying to adapt, but it just, when you brought up a certain way, you have difficulty, because the gap up, or a move up, it doesn't even have to be a gap, because a lot of times it's not even a gap. But if you go look at a stock and then all of a sudden stock market opens at 9:30 and it's instantly up $1 or whatever, and then it just kind of grinds higher all day. Right. That is like the instant one is the VWAP imbalance showing that they're going to get it up. Then it gets to a point and it just grinds higher all day. The best traders I see today are people that didn't grow up in our era, that have no desire to fade those moves. And that's I struggle with that desire to fade the move. Right. In my day, the gap up was someone demanding liquidity. I provided the liquidity. They walked away and then it went lower. Nowadays, the gap ups show someone's hand and then it just keeps going up all day. So the best traders I see today are guys that see the gap up, aren't scared of it, buy it, and just hold it as it grinds higher in a low vol move.
Buy any dip within that move.
Yeah.
That's why BTFD still the best strat. Like it is not dead. It's not on a day basis, on an hourly basis, on a monthly basis, on a yearly basis. BTFD, buy the freaking dip. Still the only strategy that has not been killed. And people have tried. How many people have tried to kill it? It's really impressive. I mean, let's talk a little bit about the market. I mean, the market is just a Terminator market. You throw anything at it and everything at it. So I have a theory. You tell me what you think.
Okay.
I saw a chart that was really fascinating. It was basically the S&P X 7 X.
The 493. Yeah. Okay.
493.
Even though technically I think there's 501 or 490. There's not 500 stocks in the S&P 500, even though it seems like there should be.
I have no idea, but that's a trivia question. We'll keep for the comments. But the point is that like at 493, the actual performance of the S&P is flat over the last like 6 or 7 years. That literally all the performance is in technology. And until technology stops, like until we stop, we went from what? PCs to cloud to AI until we just kind of run out of innovative technology, like BTFD seems to be the play. It just because we just make these incredibly marked jumps in productivity because of new technology. That's what catapults the equities up on a continuous basis.
So I hear you about that. I think it's a little more complicated in that what people fail to appreciate is the massive fiscal stimulus that has been occurring in the U.S. for the past few years. Like it's just huge. And I know, listen, I used to talk about this and people used to think I was insane and they'd be like, no, that doesn't make any sense. We finally got to the point where people are accepting that the government's deficit is the private sector's credit. So if the government spends more, there's more money in the private sector. And so it's taken a long time, but we're finally there. That's what's occurring. And what I think a lot of folks underappreciate is the fact that they kind of, let's just say you ask the typical American, you tell them that their deficit to GDP is 7%, and then ask them what Canada's or Japan's or Europe's deficit would be. Yeah. And they would say, well, UK's is actually pretty bad. So we won't use the UK, but we'll use the first today. Yeah. So they'll say, well, if ours is 7, they must be like, they're socialists. They must be like 9, 10.
Right.
And then like you tell them, no, Canada's is 2. Japan's 2.5. Europe's 3.
Wait,
and what they
GDP really? Is that low?
Yeah. So there you go. There you go. See, you don't even realize it, Boris. The reality is that the U.S. has had a fiscal stance that is just running flat out compared to the entire rest of the world. Wow. And it is crazy how much it's going. Mm-hmm. And it's created this environment where you guys were all the growth. And there's no doubt about it. It's a little bit of a chicken or the egg thing, too. Like when you go back and think about Europe, everyone says, oh, Europe doesn't innovate. The problem is that they have too much regulation. They give you all these things. And yes, I am not going to dispute that there's no doubt that Europe has some overregulation. But you also have to realize that they were busy trying to balance their budget. They were doing austerity. And when you're starving the economy of money, then there's very little growth. And I always ask people, I said, like, if you went and if I told you that the long bond was going to 10% yield, okay, if I said the long bond is going to 10% yield, you would, and I asked you, do you think the government is spending too much or too little? I think everyone would say the government is spending way too much, right? We're getting inflation where the government's doing too much deficits. That's why the long bond is 10%. Okay. But yet when it went to negative in Europe, when the long bond, went there, right, nobody ever said, maybe we're spending too little money. And so one of the benefits that the U.S. has been is that you guys haven't been encumbered by this hesitation to run huge deficits. And it's been a huge advantage for you guys because you've had more growth. You've had more, economic growth, which then attracts more entrepreneurs and which then keeps them there. And it feeds upon itself.
It helps when you're a seigneurage. It helps when you're the reserve currency.
But I don't think it's just the reserve currency. I think it's more than that. It's the reserve currency and willingness to run 7% deficits.
You, to me, let's be honest, you politicians, whether Republicans or Democrats, their only function is to juice up growth so they can provide jobs, so they can be voted to the office. And when you don't have any, U.S. doesn't have any constraints. Like Europe has constraints because European bond markets will constrain them, or the ECB is by law is constrained at like 3% spent.
There you go. So you're absolutely correct about that second point, Boris. It's been a self-imposed constraint by the government. But what's the constraint in Canada? We don't have one. What's the constraint in Japan? They don't have one.